Hey everyone, welcome back to Corporate Decoder. Today we're diving into some serious shakeups at Serve Robotics, but don't worry, this isn't your average robot uprising. More like a financial face-off, so stick around, it's gonna be interesting. Scroll date of report date of earliest event reported, March 4, 2025/scroll. This report covers events that happened on and around March of 2025. It's called an 8K, which is basically a corporate uh-oh report. Companies file these when big, unexpected things happen that investors need to know about right away. Scroll item 1.02. Termination of material definitive. Agreement/scroll. First up, Serve Robotics has ended a major agreement. Think of it as calling off a deal that was supposed to bring in a lot of money. They terminated what's called an equity distribution agreement from November of the previous year. This agreement allowed them to sell up to $100 million worth of their stock over time through several agents or brokers. Scroll prior sale agreement by Anamumbe. Company Northland Securities Inc. /scroll. The deal involved Northland Securities, B. Riley Securities, and Ladenburg Thalmann. But as of March of 2025, that's all over. Scroll penalties related to the termination of the prior sale agreement/scroll. Luckily for Serve Robotics, they aren't facing any fines or penalties for ending this agreement. They did manage to sell a good chunk of stock before pulling the plug. They sold over 5.6 million shares, raking in about $80 million. However, they won't be selling any more stock under this agreement. This could signal that they found a better way to raise money, or maybe they didn't need as much as they initially thought. Scroll item 4.01, changes in registrants certifying. Accountant/scroll. Now let's talk about another significant change. The company has switched its accounting firm. This is like changing your doctor, but for your financial records. Serve Robotics dismissed DBB McKinnon, or DBB, as their independent accounting firm. This change was approved by the audit committee of their board of directors. The change became official after DBB finished auditing their financial statements for the past year, 2024. Scroll did not contain an adverse opinion or a disclaimer of opinion and was not qualified or modified/scroll. It's important to note that DBB's audit report didn't raise any major red flags. There were no disagreements about accounting practices that weren't resolved. Scroll material weaknesses identified by DBB as disclosed in the company's annual reports on Form 10-K/scroll. However, there were some previously identified material weaknesses that DBB pointed out in earlier reports. These are essentially significant problems in the company's internal financial controls. To make sure everyone's on the same page, Serve Robotics asked DBB to confirm that they agree with the company's statements about their relationship and the audit. DBB's letter confirming this is included as an exhibit to this report, basically a formal "yes, we agree" from the old accountants. So, who's the new financial doctor? PricewaterhouseCoopers, or PwC, is stepping in as the new independent accounting firm, starting immediately after DBB finished their audit. This decision was made by the audit committee. Scroll during the fiscal years ended December 31, 2024. In 2023/scroll. During the past 2 years and up to March of 2025, Serve Robotics didn't consult with PwC on any specific accounting issues or potential audit opinions before hiring them. This is to avoid any conflicts of interest or prearranged agreements. So what does all this mean? Well, Serve Robotics is making some big changes under the hood. Ending the stock sales agreement could mean they're re-strategizing how they raise capital, or maybe they think that the stock market isn't as friendly to them anymore. Remember, they managed to get about $80 million, but that was only part of the $100 million they were hoping for. Switching accounting firms can raise eyebrows too. While DBB didn't flag anything major in their audits, the company's audit committee may just want a fresh perspective. Bringing in a big name like PwC could also signal that Serve Robotics is aiming to improve its financial controls and transparency, especially given those material weaknesses that the old firm had pointed out. Now let's put this into perspective. Serve Robotics is in the business of building and operating robots for last-mile delivery. Think of those cute little robots bringing you your takeout or groceries. It's a growing field, but it's also very competitive and requires a lot of investment. Looking at these changes, it seems like Serve Robotics is trying to tighten up its financial operations and maybe shift its funding strategy. Ditching the stock sales agreement might mean they're looking for other ways to fund their growth, like partnerships, loans, or maybe even a bigger investment from a single source. Bringing in PwC suggests they want to show investors they're serious about their financials. One potential risk here is that switching accounting firms can be disruptive. PwC will need to get up to speed on Serve Robotics' business and financial processes. If the material weaknesses highlighted by the previous firm are major issues, they could be costly to fix. On the other hand, this could be a great opportunity for Serve Robotics. By cleaning up their financial act and finding more stable funding, they could be in a stronger position to compete in the rapidly evolving robotics market. If they can demonstrate solid financial controls and a clear path to profitability, they might attract more investors and strategic partners. In conclusion, Serve Robotics is going through a financial makeover. They're ending old deals, bringing in new experts, and hopefully setting themselves up for a more sustainable future. It's important to remember that emerging growth companies change their operations and strategies frequently, so it's hard to judge the reasoning behind these moves without being on the inside. Whether these moves pay off remains to be seen, but it's definitely something to keep an eye on. Thanks for watching. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more corporate deep dives. Let me know in the comments what company you want me to decode next.